We are back to CoinMarketCap looking at Shiba Saga. And I wanted to again show we can copy the Ethereum token contract address and then go to Etherscan to see what the token's all about by pasting in here. But I've already got that contract, the smart contract up that I was showing before. And this is a smart contract that received all of the initial tokens after they were minted. So this, as you can see here, Shiba Saga deployer is the token minting contract address. This is the token contract that minted all 10 billion of the tokens and sent it to this wallet that we're seeing here. Again, this is the custodial wallet that holds 95% of the available Shia balance on the blockchain. Again, real quick, they minted 10 billion tokens, 5 times as many tokens as was marketed on their website, likely in investor documentation, etc. They sent 1 token test transaction to this wallet and then soon followed it with 500 million tokens. 400 million tokens came back from that same wallet a few days later. And then we've got 8 billion tokens being burned, sent to the Ethereum null address. And so what we want to find in this section of the on-chain analytics video series is understanding what happened initially when liquidity was added to the DEX. And so I'm assuming that because tokens were only sent to this wallet address out of any wallet that holds Shia or Shiba tokens, this is the wallet address that provided liquidity. And so we can click here to check out what happened with this specific wallet and see if we can go early enough to find that initial liquidity provisioning. We see that there's a total of 23 transactions found here. And if we go all the way down to the bottom, we'll see that initial test transaction of 1 token coming in, followed by 500 million tokens. So we verify this is the right wallet that received them. And then the very next transaction for the Shia token, 50 million going out to Uniswap V2 Shia 6. And here, Etherscan denotes this as an add liquidity ETH, which means this is the transaction that took place to provide liquidity in this liquidity pool contract address. We're not going to dive into this address specifically because that is the Uniswap liquidity pool. So I guarantee we'll just see all 80, 90,000 of the transactions taking place with the liquidity pool, the buys and the sells. But what we can do here on Etherscan is click on this actual transaction to see the details of the liquidity provisioning. We click on this, Etherscan is going to give us a bunch of different types of information. If you see down here, ERC20 tokens transferred, there's a whole host of transactions taking place to provide liquidity, but it sums it up nicely right here in the action. The team provided 50 million Shia tokens and 121 Ether liquidity to Uniswap V2. That's the LP. And down here, we see some actual values. So we've got the 50 million tokens provided and $196,000 worth of Ether provided into the LP. Now, Etherscan calculates this value based on current prices of Ethereum. So they don't go back and historically pull the price for Ether at the time of the transaction. But you know, for simplification purposes, I think over the past month or so, the price of Ether has been relatively the same. So we can just go ahead and assume that this is around the same price they uploaded into the liquidity pool. They put about $200,000 into the LP as a value backing for the 50 million tokens. And we could do some quick calculations here. I've got a spreadsheet I could show you. And so what we've got is the token supply of Shia, the theoretical supply, which should be 2 billion tokens, but the actual supply of tokens that existed when they provided liquidity into the LP, 10 billion tokens. Remember, they minted 10 billion tokens, and then they didn't burn 8 billion until several days later. On the liquidity provisioning front, they added 50 million tokens with a value backing of, let's say, $196,000. And that gives us just a very baseline theoretical token price of a fraction of a penny, zero point 0.4 cents. Gives us a K constant. If this value of the Ether backing is accurate, then this is likely our K constant. Now, what we see here, though, is that they put about $200,000 upfront investment into the liquidity pool against 50 million tokens. So the value of the entire market cap is predicated upon how much value backing they put into the initial liquidity pool. And this is a good lesson in understanding how teams can potentially manipulate the market cap in the early stages of a token launch. So if we've got 200K backing 50 million tokens, we look back to our both theoretical and actual fully diluted valuations. And we see that immediately from minute one of providing this liquidity, they have nearly an $8 million market cap on their entire total supply of Shia tokens. In fact, it's 5 times as much because they had 5 times as many tokens. Not only do they have 5 times as many tokens, but we know from Etherscan and looking at transactions on those smart contracts and wallets that these tokens are unlocked. In fact, the team was transacting them back and forth from these smart contracts. So the 95% of the supply in that original smart contract, we can say safely is unlocked. So the actual FDV that they manufactured with this liquidity provisioning is close to $40 million. They created a $40 million market cap for an ecosystem token using only $200,000. Let's do some quick math and see what we got. That's a 200x. If you consider market cap or fully diluted valuation to be a valid metric that you would base for your fundamental analysis. If you're looking at tokens, cryptocurrencies, whatever, and you're looking at the market cap and saying this asset is worth $40 million in total, and that's somehow a reflection of the assets and potential of the company and what they want to do, $40 million company, that's huge. I think in the last video, we talked about some comparisons. When this token really started flying and they reached over $1 billion in market cap, we were comparing it to Arbitrum. We were comparing it to a lot of other massive layer ones of these similar valuations, when in fact, this valuation was reached only after a few days. And the valuation was likely reached just by a little bit of hype and speculation of individuals buying into this liquidity pool. So if you think about an individual coming in and spending $20,000 to buy some Shia tokens, they add $20,000 into this liquidity pool. They think, okay, you know what? Shiba Saga looks like a pretty cool project. They're marketing it well. I like the team. I think it's going to fly. I think it's going to go to the moon. I want to be a whale. I'm going to go ahead and buy $20,000 worth of this token. Maybe you end up with a fraction of a percent, the entire supply. You think you've got something worth potentially 200x more than what it's actually worth, because the only extractable value for any of the token holders is what exists in the liquidity pool. Remember, we talked about before any liquidity provisioning happened, the 2 billion or 10 billion tokens that existed were worthless. You couldn't transact or trade them anywhere. The only place you can now transact or trade them is on available liquidity pools across decentralized and centralized exchanges. And with just a little bit of purchasing, with some buys coming in and more cash coming in here, because the purchase amount of, let's say, $20,000 in comparison to what exists in the liquidity pool is so big, this can have a massive price impact on the token. In fact, a purchase of $20,000 into the liquidity pool might take the token price up, let's say 20, 30%. And all of a sudden, instead of $40 million of fully diluted value, you have $50 million from one buy. This is how liquidity pool manipulation can push the market capitalization of your token into the billions by creating this massive price impact and adding low liquidity compared to a low token supply initially.